All right, good morning, everyone, and welcome to our July Money Matters Mastermind. We have very excited to have our guest today, the CEO and founder of Breadify, a young man by the name of Bobby Bodner. His company specializes in supporting 1099 individuals with their tax, accounting, and bookkeeping. So we are looking forward to having a conversation with him about all the things that we can be doing in the structuring of our entities and organizations to help us hang on to as much of that money that we work so hard to earn. So before we turn it over to Bobby, we always start these calls as an open book company with a sharing of our financials from the previous month and year to date. So Julia is going to take us through our highlight sheet, and I'll remind you all that through KW reports, through mykw.kw.com, you can access balance sheets and financial statements for the company from there. So, and of course, any questions, comments, concerns, smart remarks, or physical threats that you have related to the finances of this company can be directed towards me. So, Julia, without any further ado.
Good morning, everybody.
We just lost somebody after my physical threats joke, so sorry about that.
Okay. Let me share my screen here to just go over some of the numbers from June.
Do you have, okay, yeah.
All right, so we had a really great month in June, hit some of Market Center records with both best profit share month ever and also our highest company dollar month ever. So those were two milestones for June 2021. We added 16 agents, bringing our total agent count to 440, which is fantastic. One of our best gross months this year and net months as well. Our agent production, we wrote 513 contracts in June, which is up 20% from June of last year and trending up year to date as well. And of that, that is 213 of the agents in our office wrote a contract. So just under half of the agents in the office wrote a contract in June, which is really good. That's about, on average, the percentage that we look for month over month. Listings taken, we took 273 listings in June. That was up over last year and up 9.5% year to date. So trending upward there. And it was just down from May's listings, which was like 280, I believe. So still trending upward on listings. 89 agents in our office took a listing, which is only 22% of our agents. And if you haven't heard me say this before, the way that our system tracks listings taken is only the lead agent on a team gets credit for it. So we believe that is actually probably a higher number than 89, where the agents writing contracts, every name gets counted. But for listings, it's just the lead name. So that does show a lower percentage because of that. Total GCI, gross commission income, what our agents take home was just above 3.4 million, which was up 45% from June of last year, which is huge. Commissions are coming in much higher than last year and more of them. So that's up still 18% year to date. And our company dollar, which is the cap amount that agents pay to the Market Center, was $322,000 last month. That just beat our highest month record, which was October of last year. And that is up 23% from June, and we're trending upward 11% year to date on that. So we're seeing a steady incline there. And I said this earlier, but profit share, we had the highest profit share month in company history last month at $139,548 in just profit share alone, which is up 25% from last June. And we're trending upwards 31% year to date, which is really great. We had a super strong back half of 2020. So to be up 31% in the first 6 months of this year is really great, since we know some of the metrics that we hit in the last 6 months of last year may not be as attainable this time around. Our partnerships, which are super strong and help us hit these numbers, our title company, GM Title, this was the third month of the Q1 check, where we were sharing $14,152 for the 3 months consecutively. So for those of you who are GM Title partners, we just got the Q2 checks this week. So the market centers portion of that will then be spread over the next 3 months, July, August, and September. So that number will increase a little bit for the next 3 months. Our home warranties, we had $5,416 in home warranties last month. That's a little low for some past months that we've had, but that also like really fluctuates depending on when agents turn in their APHW data collection forms. And then when we receive those checks varies by month. So that has a little bit more flexibility than title. And Cross Country Mortgage, that is our MSA with Cross Country Mortgage, was up until this month $7,500 per month. Cross Country Mortgage agreement with us is to pay the market center that amount. That just increased, so you will see that go to $8,500 starting in July forward. And Greater Metropolitan Management, our property management company, $14,500 in the month of June, and that is trending upward 39% year to date over the first 6 months last year. So that has just continued to be a booming, successful company. They've gotten a ton new business and referrals from our agents. So thank you to everyone who's supporting that. It is contributing a ton to our inside income. And the final couple data points, we closed 478 units in June. That has got to be the top 2 or 3. I did not break the record, but great June, up 15%
six off of the record.
What was that?
I think it was 6 units off of the record.
Yeah, I think it's the second highest. Mike will tell us.
You can keep going.
Alrighty. And our total close volume is also like significantly up over last June, which probably isn't surprising as prices are continuing to increase still. Our total closed volume has increased substantially, and so is our average sale price. Month over month, that varies because it's taken by the closings that month. But I'm just pulling this up. Our first 6 months of the year average sale price is at $216, which is higher than it's ever been before. Also, we ended last year at $201. So does anyone have any quick questions about any of this data? I know I talk fast.
I have one question regarding the recruit brought on. I forget where that was. I think 16 new agents.
Mm-hmm.
Do we have a breakdown? How many of those were agents in production or potential cappers or like a level like half caps? I don't know if we track that.
Yeah, we do. Mike, do you want to take that, or I can?
Yeah, hold on. I'll pull up the actual numbers so we can make sure. I don't want to ballpark it for you. So we have.
I need accurate here, Mike.
I know. You hold me accountable. I appreciate it. Let's see. For the month of June 2021, we had. Spreadsheet is slow to load. 1, 2, 3. Oh, sorry. We had 3 agents in production. One of them a capper. 2 of them would be considered market share, and then 13 licensed agents.
Nice.
13 newly licensed agents joining the company.
Appreciate it.
Yeah, absolutely.
You did say you wouldn't be spending our market center dollars on getting a perm, but the Zoom call would say otherwise. Is your AC on?
There is. I'm sitting in the cold room today to keep the fridge down.
Thanks for being here.
What other questions do you have, guys? Now that I'm self-conscious about the do. All right. As always, we are, as we always say, an open book company. So anything that you want to better understand, anything you want to go a layer deeper on the numbers, we'll always welcome that. We work to track our business in the same way. We know that a lot of you track your businesses, and so if there's ever anything that we can do, also from a reporting or modeling standpoint for you, let us know, and we're excited to do that. So with that, now I want to turn the floor over to Bobby Bodner, who again is the founder and CEO of Breadify, which is a tax accounting and bookkeeping company that specializes in supporting 1099 employees or 1099 individuals. And today, what Bobby and I discussed was the opportunity for him to talk a little bit about what we can be doing from a structure standpoint for our organizations or entities, if we have them, and maybe about creating them if we don't, to help us put ourselves in the best tax position for 2022. I understand that the extended deadline is, up momentarily, and we want to be forward thinking. As Julia just mentioned, home prices are up substantially this year. Our volume as a company and our GCI is up substantially this year, which means the net commissions for our agents has the potential to be up substantially this year, which means that this time next year, your tax bill could be up substantially. And we, in an effort to serve the whole individual, we want to provide you some resources to avoid that. So I'm now going to go ahead and shut up and let Bobby start talking. And Julia, if you could give Bobby share screen potential, that would be awesome.
Perfect. All right. Well, thank you, Michael. And I appreciate the time to be able to sit here. And, my goal here is just to provide you guys as much value as possible. So, and I also really do want this to be somewhat of a dialogue. So if at any point I say anything that you're like, I didn't get that, or can you explain more about that, or explain it a different way, just let me know. I'm happy to do it. And yeah, I just really want to help provide you guys as much value as possible. So let me see if I can share my screen. All right, perfect. Can you guys see this?
Yeah, we can see it.
Okay, perfect. All right, so let's kind of hop right in. I have a good amount of content, and I am talking about taxes and bookkeeping, which is some of the most boring stuff on, planet Earth. So I'm going to try to keep this as entertaining as possible, but let's get it. All right, so a little bit overview about what we got going on today. I'm going to introduce myself and what I do. Michael did a great job at kind of giving you a brief overview, but then we're going to hit basic accounting and your mindset. Then we're going to talk about the real meat and potatoes, which is the entity selection, tax strategies, and write-offs that you guys can all take advantage of with your line of work. So your first question might be like, all right, well, who is this guy? My name's Bobby Bodner. As Michael said, I'm the founder and CEO at Breadify Financial. I'm also a licensed enrolled agent, and I help entrepreneurs, and we work with a lot of influencers, real estate agents, people making self-employed income. Basically, if you're making 1099 income, you're in the game. And that's what we try to do, is use the tax code to help you guys save as much money as possible. And one little quote that I like to base my teachings and my philosophies off of is, you got to be the captain of your own ship. So, if you don't learn the basics of just financial education, you'll always be a slave to the system. So what I mean by that is, you don't need to know how to file your own taxes. Like, you can learn that if you want to, but you don't need to be a tax professional. All you need to know is know enough to not get taken advantage of by a tax professional. Make sure they are doing their job the right way and making sure they're putting you in the best possible scenario to save as much money on taxes. So that's my goal here, is to try to provide you that base knowledge so that like, wait a minute, my CPA never brought this up, my tax advisor never brought this up, or maybe I should talk to someone else. So that's ultimately my goal, is just provide you that information so you can captain your own ship. Okay, and then the next logical question might be, what is Breadify? We're basically just a group of professionals trying to make tax accounting a little less boring, and I don't know if it's possible, but that's what I do here. I try to do that. We've gathered a team of professionals from all across the US, and we just help our clients and our members with bookkeeping, accounting, tax, payroll, health insurance, entity formation, all of these different areas that when you're self-employed, it falls on your shoulders. When you're a W-2, a lot of this stuff doesn't matter. You don't need to do your own books because it doesn't matter. There's really no write-offs for you if all of your income's coming through as a W-2. Right? I always use the example that, my dad's a doctor. He could go to the store, go buy some scrubs, right? Clearly he's using those scrubs for business. Couldn't write those off on his own taxes. There's no strategy there. So when someone comes to me, it's like, how do I save money on taxes? And all you got is a W-2. Go start a side hustle. Go do something on the side. Go do something you love. Produce some 1099 income, and then you're in the game. But really, ultimately, instead of what we try to do at Breadify is not just do things for you, but educate, allow you to be the captain of your own ship, and then put you in the best possible scenario to save as much money on taxes as possible and provide that financial education as well. All right, now we're going to talk about this. You guys might be like, okay, what is accounting? This is about as boring as it gets, but I'm going to try to just pull this back. Like at its simplest level, all accounting is a way to organize information for decision-making purposes. So the example I always like to use is if I sat you down and I threw these shapes on the table and I was like, organize this. What would you do? Maybe you would, what would you do? You might take them and organize by the shapes. You might take the squares and the triangles, the circles, and now you got 3 different groups. Fantastic. Or you might take the blacks and the blues and the reds. You put it in different groups. You took the inputs and you put them into groups to help you make decisions. And at simplest level, that's all accounting is. It has nothing to do with numbers. You can account for anything. So what I like to do is help explain topics at its simplest level so that a 5th grader could understand this, because none of this stuff needs to be that confusing. The other area that I like to talk about is understanding what taxes are, because I've heard the argument countless times. Well, it's like, it's unpatriotic to try to avoid taxes, or people should be paying taxes and you shouldn't be trying to find ways to get out of it. I think that's a nonsense strategy, but there are people who do believe that. But if you think about what taxes are, it's just a series of incentives from the government, because they understood very early, if they want the public to do something, how do they get the public to do it? They give you a tax break for doing those certain things. So if you do what the government wants, you'll pay less in tax. It's as simple as that. So what does the government want? They want you to stimulate the economy. They want you to provide jobs, affordable housing, invest in renewable energy, et cetera. And how do you do these things? You do them by either being an entrepreneur or by being an investor. Those are really the areas that you can really take advantage of the tax code. So the way you got to view yourselves, whether you do or not, as real estate agents receiving commissions, you are entrepreneurs, you are business owners. According to the tax code, it's the exact same thing. So you're in the game to be able to take advantage of all of these things that all big business takes advantage of. You guys are all in the game. So it all just comes down to learning those very simple strategies and techniques that we're going to go over today. And one thing I don't think people really get is that taxes, it's like a game. Okay. So if you view taxes as a game, you can either play at a kindergarten level or you can play at a professional level. And it just comes down to learning that base knowledge. Not so much that you need to be your own CPA, be your own tax advisor, just enough to ensure your tax advisor is putting you in the best possible scenario to save money on taxes. Because ultimately taxes will be your number one expense in life. So they will either help you become rich or they will help you become poor. When you have a certain amount of wealth, almost every decision that you take into account is going to be a tax decision. So it's really your choice on how much you want to learn about this topic. And on social media, TikTok, there's all these things like, how do I make an extra $1,000, $5,000, $10,000 this year? The easiest way to do it isn't to go do something else. It's just not give it to the government in taxes. And the easiest way to keep an extra $10,000 in your pocket is just don't give it to the government next year in taxes. All right, now we're going to talk about entities, and this is what Michael was alluding to. We're just going to, at its highest level, this is your entity menu, right? When you're starting a business, you're either a sole proprietor, you're a partnership, you're a limited liability company or an LLC, an S corporation or a C corporation. We're going to briefly touch on all your options, and then we're going to talk about what is the strategy for you guys in particular in your industry. Where should you be? What's best for your scenario? When you just start out, if you just started selling business or maybe you started receiving commission checks directly in your own name, you are a sole proprietor. You're an unincorporated business with one owner. So what happens is you'll receive a commission check, you'll deposit in your personal or whatever bank account, and you're going to report that on your Schedule C. It's the simplest form of doing business. There's zero asset protection, but you can take advantage of all of these write-offs, even as a sole proprietor. It's not like you need to be an LLC, which we'll touch on. It's a very common misconception. People are like, oh, I couldn't write that off. I didn't have an LLC. Not the case. Anything that you can write off as an LLC, you can also write off as a sole proprietor. The difference is asset protection. So that's your simplest form. If you do absolutely nothing else, you're a sole proprietor. And Michael or anyone else here, if you guys have any questions, feel free to let me know. Like, stop me at any time. Okay.
Excuse me 1 second. As a sole proprietor, what kind of asset protection, being a realtor, would I be entitled to? As a
Zero.
Protection. Okay.
Yeah. So that's the whole point here is.
I mean, I guess with it as an LLC or once you get into that protection.
Yeah. So we're gonna hit LLC right here. But
Okay.
really, the main thing to understand at this point is there's no tax difference between a sole proprietor and an LLC. The difference is asset protection. So if you got sued because maybe you're driving a client in your car, got into a car wreck, and they sued you, they're suing you personally as a sole proprietor. But if you're an LLC and you have a corporate veil around your business, then they will sue your entity, not you personally. So your house is safe, your personal bank account is safe. That's the difference. So the point being, there's no tax benefit between a sole proprietor and an LLC. The difference comes in asset protection. So the partnership doesn't apply as much to your situation as real estate agents, but it's an important concept to understand. Because if I just started to do it, maybe I went to my buddy and we wanted to go start a business selling hats. I'm like, you're good at websites, I can do the sales, let's go start selling hats. We go sell our first hat, we're in business, we're a partnership. We didn't set up any entity, we have no operating agreement, anything. We are a partnership. But this is actually the riskiest business entity formation that you can have. Because what happens is not only am I personally liable for my actions, I'm personally liable for my partner's actions. So if he goes and gets into some contract and we default on it, and then they come after us, they can, even if he did everything, I had nothing to do with it, he signed it, he did all of it, because we are a partnership, I am personally liable for his actions as well. So this right here is probably the worst possible scenario you could be in. Now we're going to hit the LLC. So when you think of an LLC, all it is it's a legal pass-through entity formed to own or operate a business. So what that means is it's providing you a bubble around your business for asset protection purposes. LLCs don't save money on taxes. If that's one thing you walk away with, it's LLCs don't save money on taxes. So anytime you hear someone say, I couldn't write that off, I didn't have an LLC, they don't know what they're talking about, because that's not the case. You can write off anything on a Schedule C that you could as an LLC. So let's just say I went up, set an LLC, I own 100% of it. The IRS literally calls this a disregarded entity for tax purposes. They don't care that you have an LLC. They could care less. The LLC is only for asset protection, like Jeremy was saying. It's if you got sued, you have a barrier around you, so they can only go after the assets of the business, not your personal assets. Okay, so that's the main thing to understand here. Does anyone have any questions on that? Okay. Next is the S corporation, and this is really the bread and butter, no pun intended, of Breadify's entire tax strategy. The S corporation is a commonly misunderstood tax election used to save money on self-employment tax. So we're going to break that down as we go. What is self-employment tax? What is a tax election? All those things. But the thing to understand here is that an S corporation is not an entity. So it was a little misleading that I put it on that entity menu, because you can't just go form an S corp. An S corp is a tax election on an LLC or a corporation. So when you go to the state's website and you want to go set up an entity, you're either setting up an LLC or you're setting up a corporation. And then you would tell the IRS or the state that you would file one form and you say, hey, I want my LLC or my corporation to be taxed as an S corporation. So it's a tax election, not an entity. And then finally, we have the C corporation. We're not going to talk about this very much because it really doesn't apply, especially in this situation. This is for big business, publicly traded companies. If you're set up as a C corporation, I honestly, you probably have some bad tax advice. You should, very few scenarios, small business should ever be set up as a C corporation. So we're not even going to really touch this. And now your next logical question might be, which entity is best for me? So of course, just like any professional tells you, it depends. There's no one size fits all approach, but there are best practices. And that's what we're going to go over today, best practices. The typical entity progression. This is what you see. This is what we see. And this is specifically for ordinary income. So before I hit this, what's on the screen, I want to go over the difference between ordinary income, passive income. if you divide your life directly down the middle, think about one half being ordinary income, which is what, as a professional real estate agent, when you receive a commission check in the mail, ordinary income. You went out, you worked, you provided a good or service, you received ordinary income. That is what we were talking about today. And that is separate from passive income. If I own a rental property and I receive rental checks, or I receive dividends, or I receive royalties, these are all passive income, and that's a different type of income where an S corporation will not help you. So right now we're going to talk about ordinary income, the commission checks you receive from Keller Williams or any other 1099 income you receive. That's what we're talking about here. So the way it typically goes is you just start out as a sole prop. And as you can see here, you got this dotted line representing there's zero asset protection, but there's no tax benefit from hopping from a sole proprietor to setting up an LLC. There's no tax benefit here. The only benefit you received is this circle. You have a hard circle around you, also known as the corporate veil. And that corporate veil will protect your personal assets from liabilities within your business. And then the next progression is taking this LLC and getting it taxed as an S Corp. So you're still an LLC. Maybe, it's Bobby Bodner LLC. That's my name. When I file to become an S Corp, nothing changes with my LLC. It's still Bobby Bodner LLC. It's just taxed as an S Corp. The IRS knows to expect a different tax return. It's taxed differently. So the S Corp is ultimately where you want to be. And we'll talk about when's the best time to be there and what the pros and cons of this formation is. But this is the typical entity progression for someone making significant 1099 or real estate commission income, right? Sole prop, set up the LLC, have that LLC taxed as an S Corp. Does anyone have any questions on this? Okay. Now, do I need an S Corp? Eventually, yes. Right now, maybe. Okay, so things to consider for an S Corp. The benefits, and the main benefit is significant tax savings, and it comes in the savings of self-employment tax, which we'll hit on next. Next is asset protection, like we said, and this is asset protection compared from a sole prop to an S Corp, not an LLC to an S Corp, because those are the same. Asset protection is exactly the same. The difference comes in the tax savings. And then finally is audit risk, and this is most people don't know this, but the way this works is if I'm making the same amount of income, maybe made 100,000 net as a sole proprietor, filled it out, put it on my Schedule C, I have a higher chance of being audited on a Schedule C than the exact same amount of money, 100,000 net, going through an 1120S business tax return. And the main reason for this is because the IRS knows people filling out Schedule Cs have no clue what they're doing. People feel very comfortable filling out a Schedule C. It's on there. It's on their 1040. It's one form. Throw it in there. How much did I make? I'm going to write it off. They throw it on there. Send it in. Great. Once you get into an 1120S or a 1065 or these other business tax returns, they're more complicated. I mean, that's typically when someone upgrades to dealing with some sort of professional, whether they're just getting advice, whatever it is. 1120S tax returns are audited about 10 times less often. IRS sends out this data. How often are certain areas taxed, which different tax returns are audited? And this is one of the main. It's not the main reason. The main reason is the tax savings, but this is another reason. Get off the Schedule C. Schedule Cs are audited more often than business tax returns. And now the other thing you might be asking is like, okay, great, S Corp's the answer. Why don't I just do that right now? Why are you not why is there a point I need to become an S Corp? Why don't I just do it right off the bat? The main reason is because there's additional costs, and these costs are payroll. When you're an S Corp, you now wear two hats. You are a business owner, and you are the employee of that business. You have two different roles in your business, which means you need to run payroll, which means there's a W-2 involved, which means there's 941s and payroll tax reporting. So there's additional costs to become an S Corp. Additionally, there's an 1120S tax return that I've alluded to. That is the tax return name of an S Corp. So when you go from a Schedule C to an 1120S, you're going from maybe paying your accountant or doing it yourself, doing your Schedule C on TurboTax, whatever you're doing, to going to a completely different tax return. So now you have a 1040 personal, but you have an 1120S, which means you have a K1. So you're going to pay someone, or you're going to have to learn how to do this yourself. There's additional tax reporting that comes with being an S Corp. And then you have the entity setup and fees. That's really, if you're going from a sole prop to an S Corp, is the entity setup and the fees. And then you have company maintenance in order to keep that corporate veil strong. So if we look back at this, if all I did was go to the Secretary of State's website, I got a piece of paper saying, you are officially an LLC in the state of Ohio, but I don't do anything else. Maybe I'm signing contracts still in my personal name, making personal guarantees, and maybe I'm taking all of the commission checks I receive and I'm depositing into my personal bank account. If I'm doing all these things, I'm not respecting the LLC. So if I got sued, the attorney at the other end trying to pierce my corporate veil, which is what they call getting through an LLC, is what they're trying to do. And they're going to prove that, if you're not respecting the LLC, why should the courts? So you've got to maintain there's company maintenance, and you have to take corporate minutes and things that go with being an LLC, being an S Corp. And finally, bookkeeping. Bookkeeping is what no one likes it. I help people with it all day long. Everyone hates bookkeeping. It's annoying. It's basically like, when you're in the gym working out, if you're a professional athlete, you're not in the gym just to work out. You're in the gym to get better at the game. And that's what bookkeeping helps you do. It's like the workout before the actual game. Filing the taxes is the game. But if you didn't prepare and you didn't do all this work before you got there, your tax return is going to be garbage. You're going to pay way too much in tax. So the bookkeeping, so whether you want to do it yourself, you want to set aside the couple hours a week, or you want to pay someone to do it, bookkeeping is a necessary evil, and it's even more necessary when you're an S Corp. All right. Any questions there before we hit this next very important topic? Cool. Self-employment tax. You guys might, the F word, people think of the F word. There's in accounting and tax accounting, there's another F word. It's even worse. It's called Fica. Fica is the real F word, and Fica sucks. Fica is the 15.3% tax that consists of Social Security and Medicare for the self-employed. It's also known as self-employment tax, also known as SE tax. So those are all the same things. But what happens is it's Social Security 12.4, Medicare 2.9, making up 15.3%. And when you have a normal W-2 job, you pay half that. So it just comes right out of your paycheck. 7.65% is paid by the employer, 7.65% is paid by the employee. But you, as a self-employed individual, are paying both halves. You are both people. So you're paying 15.3%. And that is an absolute killer. And this right here is what the S Corp does. So if you're like, okay, cool, like the S Corp's great, what is it doing? This is what it's doing. It's avoiding and eliminating, and not eliminating, but lowering your self-employment tax. Okay, that's ultimately what's happening here when you are an S Corp, is you're lowering your self-employment tax burden. And this is a visual representation. I'm going to kind of walk you guys through what this is showing and what this is doing, but high level overview, this is what the S Corp is doing, and this is what it is saving you. So we're going to take apples to apples comparison here. We're going to take someone making 150K revenue with 50K business expenses, arriving at a net income of 100. One is a sole proprietor filling out a Schedule C, and one is an S Corp. So one's flowing right through their Schedule C, and one's flowing onto an 1120S tax return. And we're going to show the difference in the tax savings and what's going on here. So 100K net, sole proprietor, 15.3% tax. That arrives at $15,300 in self-employment tax. And that's right off the top. That's before you pay federal, state, local taxes. $15,300 right off the top. Now let's take that same amount of 150 minus the 50 business, arriving at the net of 100. What you do, and what you do as your tax professional and payroll, is you're going to take a W-2 and a K-1. And this is what is happening with the S Corp. You have to arrive at what is called a reasonable salary. That's what the IRS wants. They want you to take a reasonable salary. And every situation is a little bit different. Industries are different, but a typical reasonable salary at this price level, maybe you're going to take a $35,000 W-2, and the rest is going to pass through as a $65K1. So you still have that 100 net, right? You still have the 100 net income, but instead of it all flowing onto your Schedule C, 35,000 is going to go W-2, and 65 is going to go K1. So what that means is instead of paying 15.3% on 100K, you're going to pay 15.3% on 35K, arriving at 5,003. So you're still paying self-employment tax. You're not avoiding this completely. You are lowering the self-employment tax burden. So you're paying less into FICA, Social Security, and Medicare. The remaining 65 flows through as a K1 onto your personal return, completely avoiding self-employment tax. You're still paying federal, state, and local tax. The savings come from self-employment tax. So does this make sense? Do you guys have any questions on this comparison?
So that net income number should be 110 then, right?
For what? Why?
Because I saved 10 grand. Should I pull more through my K1 then?
Okay, so yeah, okay, so this is a good question. People are like, okay, cool. Okay, so W-2, right? If I take less W-2, I pay less self-employment tax. You take less W-2, you pay less self-employment tax, you get more audited. There is a line here. The IRS knows this is going on, and the IRS completely gets that you can do this, and it's legal. You're allowed to do this, but you need to take a reasonable salary. So at the IRS, there's very little guidance on what that means, and all you can use is case studies and previous audits to determine what is reasonable. But what would you have to pay someone to do your W-2 role in the business if you outsource it, is ultimately what they're looking for. So if I made 100K and I was the business owner, what would I pay an employee to help me get there? 35K. And there's something called a payroll matrix. The more you make, the less you have to take as a percentage of total. So this is something that you would work with your tax advisor on. This isn't like everyone should do just these numbers. This is a moving scale. And the more you make, the less your percentage of W-2 is, even though your W-2 is going up. So is that answering your question?
Yeah, I guess if I'm looking at this though, like I've paid $10,000 less in taxes, where is that $10,000 showing up in elsewhere? Because you're like the number at the bottom is, I mean,
this 100K.
Yeah.
When you run your numbers and you run a profit and loss statement, I made 150, I wrote off 50, and I have 100 net.
Oh, that's the start. That's my start.
That's the start. Yeah. And so the 100 net is what you're using. Yeah. To get there. So because this isn't your full tax liability, but instead of paying 15,300 plus your federal, state, local, you're paying 5,000 plus federal, state, and local. So that's the 10,000 tax.
I was putting the taxes in the expense bucket as a liability. That's fine.
Yeah. Okay. Yeah.
Sense.
So
Perfect sense.
It's afterwards. Okay. Cool.
Yeah.
Any other questions? All right. Now, this is the stuff people enjoy. People are like, okay, I see this 50,000 expense thing. The thing about being self-employed or being a business owner is you don't get taxed on your gross. You don't get taxed on this 150 up here. You get taxed on your net. So the goal here is to get this net as low as possible. You can bring in a bunch of money. If someone says, I made $1 million last year, they brought in $1 million. I'm like, oh, fantastic. What was your net? I don't care what your gross is, because if it costed you $999,000 to bring in $1 million, then you netted $1,000. There's a lot easier ways to net $1,000 than to bring in $1 million and pay out $999,000. So the thing is, of being self-employed is this number doesn't matter as much as this number. This is the number you're getting taxed on, the net. So how do we lower this number to get and increase this number to get this number as low as possible? Because that's ultimately what we're taxed on. And that's where business expenses come into play. So what is a business expense? This is an important concept to understand. And there's no list at the IRS. There's no like you go on there and here is every single thing that you can write off, because the IRS could never do that. Every industry is different. A business expense for one person would be a personal expense for another person. So the two words you got to be familiar with is ordinary and necessary. What is an ordinary and necessary expense? So according to the IRS, any expense incurred to help you make more money in your business, but there's no actual list. So almost anything can be a business expense if framed and documented properly. So let's break down those two words: ordinary, necessary. Ordinary in your line of work. So let's do this. If you're a real estate agent, which most of you are, you drive around clients and you're driving from property to property, and you might have a pretty high auto write-off, right? Whether you're taking the actual or the mileage, whatever it is, you're driving your car a lot, and you are going to take a tax write-off for doing that. And that's going to look very normal on a real estate professional's tax return. But let's take the other person's example of a dentist. Maybe I'm a dentist and I have my own practice, so I'm filling out and I'm keeping track of my business expenses, and I write off a huge auto deduction. That's going to look very weird on a dentist tax return, because are you a traveling dentist? What are you doing in your car that is making you spend so much money on your auto? It's weird. So this is why there's something on your tax return. It's called a NASIC code, and that's what puts you into buckets at the IRS. And there's not a human being scrolling through this. They're just doing it based off of this code you have on there, saying other people in your industry, other people in your area, how much did they write off? What areas did they write off? Did they have a large auto, whatever. The dentist, that would look weird. A real estate professional, very normal. So ordinary in your line of work. And then the other part is necessary. Was it necessary for you to spend this expense? Was it necessary for you to drive around your client to get them there? Was it necessary for you to spend this money to show this house to produce income for your business? If you can say yes and yes, there you go. You're on your way to a business expense. Ordinary and necessary. Those are the rules you got to really think about. And this is kind of a pro tip that I try to instill in people's heads is, as a business owner, which all of you should see yourselves as, every time you swipe your card at the store or buy something online or go and do anything, you should be asking yourself, how can I turn this into a business expense? Just, you'll have your business card, you have your personal card. And every time before you swipe it, you should be like, is there a way to turn this into a business expense? And even if it's not 100% business, right? Maybe you're buying a drone that you're going to use to make marketing and content for the house that you're trying to sell. That's awesome. Okay. But maybe you also like using it at home and recording stuff recreationally. So maybe you're like, okay, maybe it's about 80% business, 20% personal. You're going to use your business card, keep track of it, but you're going to write off 80% of the purchase price, not 100. So there's a lot of arbitrary things that go into tax write-offs. But the important thing to remember is always ask yourself, is there a way for me to turn this into a business expense? If the answer is yeah, maybe, yes, use your business card, keep track of it in your bookkeeping software, and then we'll account for it at the end of the year. This right here, not an all-inclusive list, like I was saying, anything can be a business expense, but here's just a general idea of things that we can talk about, right? Travel, auto, meals and dining. Meals, another great strategy. Meals are 100% write-off for the next 2 years. It used to be 50%. You can write off 100% of meals for 2 years to help stimulate the restaurant industry due to COVID and all that. That's a nice little perk there. Technology, anytime you go buy anything at the Apple Store, Best Buy, whatever, you should be asking yourself, how can I use this in my business? Can I write it off? And if so, is it 100%, 80%, whatever it is? Anything you buy over there, you're trying to find a way to write off in your business. Your home office deduction. Here's a nice little, no one does this, and everyone should do this. Have a board of advisors, okay? It's an amazing tax write-off. It's better for asset protection, but here's what you do. Go to your 3 to 5. You can go to your parents, your kids, your best friend, your significant other, whatever. The people you sit down and you're around and you'll talk business with. Put them on your board of advisors. So now you can have board of advisors meetings. You could take them out to dinner, write off the travel, write off the meal, right? Sit there. You could literally have a board of advisors meeting at the halftime of the Super Bowl. Sit there, buy the food, talk business in the middle of the Super Bowl. You wrote off all your food. You got a tax write-off for watching the Super Bowl. It's all about being creative. And having a board of advisors is a fantastic tax strategy. And yes, you have to document it. You have to have corporate minutes and all those things. But it is a great way of sitting down, talking business, and getting a write-off. Take your board to Vegas, pay for their trip out to Vegas. Make sure you sit there and talk business before you go gamble. But you just got to write off to get to Vegas. And that's what I'm talking about. It's all about being strategic and creative here. Health insurance premiums. Self-employed, you get to write off your health insurance. Equipment, software, subscriptions, education, advertising. It's not all inclusive. Anything can be a write-off. Okay. Do you guys have any questions? Okay. All right. So the other thing to keep in mind is it doesn't need to be all or nothing. Something can be, if it's above 50%, you can write off if it's at least 50% business, you can write off 50% of those expenses. Let's take the example. Yep, you have a question?
Yes. So just for clarity, so the board of advisors falls under the S Corp tax election LLC.
So you don't need to be an S Corp. The S Corp saves on self-employment tax, but this specific write-off, having a board of advisors, you could do it as a sole proprietor, write off on your Schedule C. You can do it as an LLC. Just sitting down and talking business with people that you are close with, putting them on your board, and being an entrepreneur can be lonely. I'll tell you that much. You don't need to be an S Corp. If that's your question, you can do it as a sole proprietor. You can do it as a LLC. You can do it as an S Corp. Any formation works, but you still need to properly document it, right? You need to have corporate minutes. You need to show that they actually are on your board, and you don't have 50 board members. So every time you go out to dinner, you're writing off your meal, right? There needs to be a business purpose, and that's why 3 to 5 people is a good amount. Did that answer your question?
Yes, thank you so much.
Okay. All right. So here's another rule of thumb, things to keep in mind. For example, if I go out and buy a brand new laptop, maybe I paid a couple grand for my great new laptop. Clearly, I'm going to use it for business. I'm using my laptop right now for business. But the IRS also knows that I send personal emails. Maybe I surf the web sometimes personally. They know I'm using the internet and a computer for things other than pure business. So in order for me to take a 100% write-off for my brand new laptop, I need to have a second laptop, maybe my old laptop. Because if you ever got audited, they'd be like, oh, you have one laptop? Well, how do you talk to your mom? How do you talk to your friends? Clearly, you're doing that. How are you doing it? We'll be like, oh, wait, IRS agent. No. I have this laptop that I bought, and I use this personally. Another example is the cell phone. If I want to write off 100% of my cell phone, clearly the cell phone is, I'm using it for business. You as a real estate agent, you're using it for business. You're on your cell phone all day for business. You should write it off. But if you want to write off 100% of it, you need to have an alternative for personal use. So a lot of people do, if you have a home and you have, remember, landlines? Yeah, landlines that will come free with your internet package or come free with your cable at this point. You can say, no, I use my landline for personal calls. That's how I call my mom. But for business, cell phone. This is why I have a cell phone, 100% business. So in order for you to write off 100% of something that you're clearly using for business, you need to show you have an alternative that you use personally. So that's just a nice little pro tip things to keep in mind.
Real quick on the cell phone piece. Last year, I have an iPhone and I go through Verizon, and you can have multiple phone lines for like going into one iPhone. And so I set up as a business account with Verizon. I've got my personal number on one line, my business number on another line, and it's all going through the same device. So that device is a business device, and the majority of the bill is a business bill. Yep. And so reduced my personal liability for the cell phone and got to write off 100% of it, or 90% of it.
Yeah, exactly. So if you could look at the bill or whatever, and you can say, okay, this percentage of it was personal, you don't write off that, you write off everything else. So if you did the 90-10 split, that's a very common split for people. But I'm saying if you want to get that full 100, you're like, all right, I want 100% of this. Yeah. You got to have a second version of that thing. Right. So a landline at home, an old cell phone, something that is actually being used for the personal side, and then you could write off 100% of that business. Oh, and here's another pro tip. If you have kids, get them working in your business. Have them shred papers. Start paying your kids, and then you can contribute to a Roth on their behalf. This is a whole other tax strategy, but paying kids, it's one of the best. It's one of the best of being a business owner. And also, if your kids are on your board, you talk business with them, they work for you, you can write off their cell phone bill as well. Okay, bookkeeping. Like I was talking about, bookkeeping is that no glory part of the job. No one likes doing it. It kind of sucks, but it's part of the game. If you want to be good at taxes, you have to be good at bookkeeping. And the better your system is, the more you will save throughout the year. There's a few things that you're just not gonna be able to write off. Okay. I mean, honestly, like there's a few things that you just might have to pay for personally, even as a business owner. For example, things like underwear, right? Clothes, except for uniforms. Even if you're like, I need to look good for my job, right? I want to show that I'm worth $1 million. I dress in a full suit every day I go to work. You still can't write off the suit. The IRS knows that you're going to go to bar mitzvahs. They know you're going to weddings. You're going to wear the suit, right? You can't write off the suit. You can write off clothing if it's marketing and advertising. So if I go buy some hoodies and crew necks, if I go buy some sweatpants and gear that I plan on giving out to clients, or I plan on marketing my business, whatever it is, now we're talking. Now you're writing off your clothes and you're getting a advertising and marketing deduction. But you can't just buy everyday clothes. Even if you do only wear it to business, meetings, whatever, clients, still can't write it off unless it's a uniform. If I'm a mechanic and I have the Bob written right here on my uniform, I'm writing that off. But it's not any everyday clothes, out the window. So gym memberships. This right here, even if you're like, I need to look good for my job, I need to stay fit, it helps me perform, work better, you still can't, it's not going to fly. You're not going to be able to write off your gym membership. However, if I'm a personal trainer and I need to go to the gym to train my clients to produce income, writing off a gym membership for a personal trainer is an ordinary and necessary business expense. That's why this isn't like a list for everyone, right? But if you're a real estate agent, you can't really justify gym memberships. So that's something to keep in mind. Travel without purpose. I work with a lot of influencers, people making money online where they can just work from anywhere. And they're like, yeah, I travel to Hawaii and I work from my laptop from the beach the whole time. Can I write off my trip to Hawaii? And I'm like, well, why'd you go to Hawaii? And they're like, well, I just wanted to go there. I worked the whole time. So it's a business expense, right? He's like, no, you need to be, you could have worked from anywhere. You didn't need to go to Hawaii unless there was a reason you needed to go to Hawaii, to go to a meeting, to meet a client, to do a deal, whatever your reason is out there. Now we're talking. But if you just went there, you worked the whole time, doesn't matter. You needed a reason for that trip. Entertainment, gone. Tax Cuts and Jobs Act, cut that one out. That'll be back sometime in 25, 26, hopefully. Country club, people love, I got to talk business at the country club, and that's where I do my business deals. That's great, but unless you're going, you could write off the meal at the country club. You want to go take them out to a meal, you write off the meal at the country club, but you can't write off your membership dues. And then the other one being commuting costs. So if you're driving every day from your home to the office, and back, that's a commuting cost. The way the IRS sees it is everyone does that. W-2s, 1099s alike, everyone does commuting costs. You should not get an advantage as being a 1099 to write that off. But the second you go from the office to your client, to that house showing, whatever it is, now these are all business miles. But going from the same place to and from your home to your office every day, those are not business miles and should not be included in your auto deduction. And we're almost done here, so I'm sorry if some of you guys fell asleep. Tax prep is an art and a science. And the main point of this slide is you got to find a tax professional or someone to work with that has the same risk tolerance as you. There's a spectrum here. There's some CPAs or some tax advisors that are scared of their own shadow. They don't want to talk to the IRS, and they're just like, they wouldn't even touch a home office deduction. You are legally allowed to take the home office deduction, and you should. You should be legit with it. You shouldn't take advantage of it, but you should take a home office deduction. I am sure you're doing work at home. Okay. So you should, but the thing is, maybe you're one of those people who's like, I don't agree with that. I think it's my patriotic duty to pay as much in taxes. I want to help the US, whatever it is. If that's your belief, fine, go work with a tax professional who believes the same thing as you. But that's not how I see it. I think you should be able to use the tax code and do what every big business, successful, wealthy individual in the United States has done for centuries. Use the tax code to your advantage. All it is a series of incentives. If the government didn't want you using it, it wouldn't be written. Another example I like to use is that I literally have the tax code, Internal Revenue Code. It's at my other desk. It's massive, okay? The first 60 pages of this book is what is taxed. The bottom line is it's everything. Unless it's specifically exempt, everything is taxed. The rest of this book, the remaining 5,000, 6,000 pages in this book, is how to get out of your tax. Okay, so it's how the entire thing. You want to know how the rich and wealthy don't pay taxes? Because they paid someone a bunch of money to read the rest of that book. Then they did the things in the book. So it's all up to you how much you want to learn about this. But the main thing is find a tax professional that has the same risk tolerance as you do. Take advantage of the tax code, but don't go overboard with it. You know, pigs get fat, hogs get slaughtered, that type of saying. Take advantage. Don't go above and beyond. All right, we're done here. So if you're overwhelmed, if maybe you fell asleep at your desk, you're drooling on yourself at this point. If you want to learn more about this or anything else, you know, feel free to schedule a call with a Breadify member. There's a Calendly link below. If you want to learn more, you go to breadify.com. I'm also working with Michael and the Keller Williams team to offer special deals specifically for you guys as Keller Williams agents. So if you want to learn more about that, or you just want you want to talk further, I can talk about this stuff all day, as you can tell. So feel free to reach out. But that's about it, Michael. I don't know if he's here or not. Do you guys have any questions or anything you want me to review or go over?
As far as the limiting our self-employment tax as it pertains to Social Security, how does that affect down the road, you know, whether Social Security is here or not for us, our ability to collect?
Yeah. So that is the argument. That is the argument of why are you trying to avoid self-employment tax? Because if you pay into it more, you get more benefits down the road when you retire. That is the counter argument of the S Corp. The way I see it is the benefit. Warren Buffett, who's been, or any of these extremely high paid W-2s, if you're maxing out self-employment, you will receive a marginally more, like a larger check at the end of the day. And that's if self-employment tax is still around. I mean, that's if Social Security is still around by the time we're collecting. For me, I have no clue. If it was up to me, I would short it. I would rather take my money, keep it in my pocket, invest it wisely with a solo 401k or Roth IRA, and use it and plan for my own retirement. That's the way I see it. It's like, I'm going to take, instead of having the government just send me a check in the mail because I want them to take care of me in my older age, I would rather, invest in the things I know and learn how to make money and plan for my retirement on my own, keep the money in my pocket instead of giving more to them in the hopes one day I will receive it down the road. So that is the counter argument of, well, you're limiting how much you'll receive, but it's so marginally beneficial. If I'm paying in, $6,000 a year versus paying in, maxing out at maybe $15,000, $20,000 a year, yeah, maybe I'll receive an extra $500 a month down the road. But is that worth it to me? No, because I would rather take that money now, time value of money, invest in what I know, plan for my own retirement, and not even have to worry about them being solvent by the time I am collecting, Social Security.
Makes sense. Thank you.
Yep. Any other questions?
Really quick. So I understand what you were saying about writing off a home office, but what we pay to the market center, like the monthly fees, like for the technology, E&O, things like that, are monthly charged to the market center. Are we able to write those off as well?
So what is the market center? You're paying, and is it a place to use resources for your
Yeah,
business?
the
Those are
brokerage.
business expenses.
Okay.
Yeah, absolutely. Absolutely. Yeah, I mean, that's an ordinary necessary business expense for you guys. I think that would very easily count. So I don't know the specifics of what is entailed there, but if it isn't, that's why it's really important to understand the terms ordinary and necessary. Because like if you can say yes and yes to that, or other real estate agents writing off a similar expense, yes. Was it ordinary and was it necessary for me to produce income? Did I need to use those resources to get a new client, to close a deal, whatever it is? Yes. So there you go. I mean that's really the main thing, is why I, instead of harping on here is how to write off travel, or here's what you need to write off, it's how do I turn these expenses that may otherwise be personal into an ordinary and necessary business expense. Because if you can say yes and yes, you can write it off.
Okay, great. Thank you.
Anything else? You got any questions, Michael?
There was a question in the chat, just if somebody can capture these slides.
Oh yeah, absolutely.
Yeah, excellent.
Yeah.
And then for no other questions from me. I just wanted to say thank you. This is really good. Actually, I did have one question. The example you used around the S Corp was at 150K revenue. Is that the number that you would say is appropriate?
Okay, yeah, good point. This is a good point. Let's hit this real quick. So the reason, remember we talked about there are benefits and costs to becoming an S Corp, and we have this typical entity progression of I'm starting off as a sole prop. I graduate to the LLC when I'm ready to take my business seriously, get an entity, go under something other than my personal name, provide asset protection, and then ultimately this. So the question is, when do you do this, right? Is that ultimately what you're getting at, Mike?
Yeah. What's the number I got to be running through that LLC to be like, hey, yeah, I'm saving 15 grand is great, but if I'm spending 20 grand to save 15,
get there,
that's
exactly.
not great.
Okay, good question. And there's a typical rule of thumb that we use, and it's when you are netting around 40,000 a year, which is why I think that you guys, because you guys are doing that, you have your open books, you review financials every month. So if you're actually sitting here and listening to that, you understand net income. Other people I talk to, they're like, what is net income? They just think it's like that top line number, but it's not. And that's why it's like, that's why gross doesn't mean as much, because you've got to understand this, because this is what you're taxed on. So this is the number you want to look at. I use the example of 100K for easy round numbers, but the cutoff of when this transition makes sense typically is around 40K. So if you are netting more than 40K annually, that's when you need to really consider, because that's when the cost benefit analysis of all of these things come into play. And it could be less. You could, if you're going to be doing your own tax return and you know how to do payroll yourself and you're not going to pay someone else to do it, your cost benefit's less, right? And it also depends on what state you're in. I work with people in California where there's an $800 minimum franchise tax just for having an LLC. So you make $0. California wants $800 just because you have an LLC. In Ohio, it's different. So your cost benefit will be different, but it really is, you would add up what it's going to cost you to do this. So you would say, am I going to do my bookkeeping, or am I going to hire someone to do it? If I'm going to hire someone to do it, what's the cost to do that? And if I am going to do my own tax return, fantastic. You better really know what you're doing. But if you're going to hire a tax professional, what's it going to cost to do it? And then payroll, same thing. Are you going to run it, or are you going to pay for Gusto or ADP or any of these other service providers to do it? Add up those costs and then add up your tax savings. And an easy way to determine your tax savings is take your net, multiply it by the 15.3%, and that's what you would be paying. And then I would cut it in half and then multiply it by 15.3%. And like the subtraction between those two numbers is what your tax savings is. So if you didn't listen to anything I just said, the main rule of thumb is 40K. If you're making more than 40K net, you should highly consider the S Corp.
So, for anybody on the Zoom, who needs that framed out another way, when you, as a capper in the company, right? Let's say if you're capping it, let's call it $2.5 million. So that's $75,000 in GCI at a 3% commission rate. that at minus $21,000 in cap, that's 50,000, right? Fewer business expenses or $10,000 or less, this would be something worth pursuing. If you're above that, then it's I mean, you know, every nickel above that is going to be that much more valuable.
Yep, absolutely. So that's a great way of putting it. And the other thing to remember is, like, I'm telling, if you really sit down and you looked at what you spent over the past year, I'm telling you, a lot of your expenses would qualify as some sort of business expense, because it's what we do. You know, when you're a business owner, you're working for yourself, like, you spend a lot of your own money on things that help you make income for your business. So if you're only finding 10,000 expenses, maybe you did only spend 10,000. Maybe you didn't go out very often to eat. Maybe you didn't travel very often. Maybe you didn't drive very often. Maybe you didn't spend that much money on equipment and technology and computer and cell phone and all that. But I'm telling you, if you really looked at your numbers and found, you can find more than $10,000. So if you're making 50 gross, you should be able to find at least, you know, 15, 20,000 to get you in. And so that's the thing, is like, there is a cutoff period of when it makes sense to become an S Corp, but the main thing to consider here is, how can I increase this expense number? You know, I want to increase my gross, but how do I increase this expense?
So there's, you know, it's really the three phases of the game is, you know, you can't net what you don't gross. So, right. Yep. And that's our primary position, is to help people buy, sell, or invest in real estate. Then from there, it's, I've increased my gross, now increase my expense profile, right, to reduce my tax liability. Once my expense profile is at a place that I feel comfortable not getting audited and everything's ordinary and necessary, then I can evolve into the S Corp to save myself that bonus, you know, 10 points or whatever it nets out being based on my income. But that would be the 1, 2, 3 in terms of how do I order out the things. So if you haven't sold a house yet, being an S Corp's not a good idea. Let's go sell a bunch of houses, then let's take a bunch of expenses, then let's modify to an S Corp. So
there's one thing that I think it's really important, especially at this time of year, or something to consider. Maybe this happens a lot. You're a business owner, maybe you just got into real estate, you haven't sold your first house yet, but you want to hit it running. You know, you want to get out there and make some money. All right, so you're gonna try really hard to do this. You don't know whether you're gonna make enough to become an S Corp or not, but you're going to try. So one strategy is, you set up an LLC now. You set up the LLC. You don't tax it as an S Corp. You set up an LLC. In Ohio, it's $99. Super easy. You get an LLC for $100. We call this S Corp insurance. So what that means is, I'm not going to do the S Corp election right now. I'm going to operate as an LLC, which basically means I'm still filling out my Schedule C, same game as last year. But if I end up killing it this year, and I'm netting, maybe I netted 100K, just like this example, I netted 100K, and then you go to your tax professional and you're like, oh man, you know, I'm still an LLC. I never filed the S Corp election. What do I do? I'd be like, well, I'm glad you asked, because what you can do is you can backdate an S Corp election to the start of an LLC start date. Okay. So basically it's like an S Corp insurance. So what happens is, if I set up the LLC January 1, 2021, but I didn't tax it as an S Corp, you come to me in like August, September, October time, you had a fantastic year. You did way better than you thought you were going to do, and you need to be an S Corp. Otherwise, you're going to pay way too much in tax. I can backdate an S Corp election to the beginning of 1/1/21, but I could not backdate an S Corp to the day before you were an LLC. You can't become an LLC, or you can't become an S Corp as a sole prop. You can't do it. So that's one strategy, is if you think you might have a great year, you can set up the LLC now and then backdate an S Corp election when you are sure you had a great year. And so that is one strategy. It's called S Corp insurance, is what we call it. Does that make sense?
Love that. Yeah, absolutely. Absolutely. And I mean, for $100 to have the opportunity for the corporate bail alone is,
yeah, exactly.
So,
exactly.
And then if you flip the switch later on, I mean, I've got, personally, I have an LLC that just sits as an LLC. It's not yet an S Corp, and will be eventually.
Yeah, there you go. And that's a great little strategy that I don't think many people understand, because let's just take that exact same example of, you had a great year, but you didn't do that LLC, and you come back to me, maybe you set up your LLC in July. All right. If you came to me and you made a bunch of money before July, January to July, that's all getting taxed right on your Schedule C. There's no game there to be played. It's going on your Schedule C, but anything from July forward, we can backdate it. So it's like a stake in the sand of when you set up that LLC. That start date is when you can start the S Corp election.
Love that.
Bobby, can you talk about what that consultation looks like and what you review? Do you look at tax returns, or what information you're looking at, and kind of what
Sure.
the evaluation looks like at the end, what you're leaving us with before we
Sure.
decide to, enter into a relationship?
Yeah, absolutely. So the first step is you would contact one of these team members, and they'll just, there's a little questionnaire. It's about 8 questions of getting a brief idea of where you're at. Do you have an LLC? How much do you know? How much you make? What are you spending on average monthly? And we'll have that information. So you would fill that out, and then you would talk to a team member. And if it's a good fit, because here's the thing, I work with a lot of people that they're not ready to be an S Corp yet. So we offer other forms of education where it's not us doing it. Because until you're at the point of at least netting 40K, therefore you're ready to be an S Corp and set up payroll and do all of those things, you would be paying us more money than we'd be saving you. And we never take on someone where that would be the case. Like that's like our whole goal here is, why would you pay us more than we're saving you? No point. So the first step of this process is to determine, are you at the point where we can really help you, or can we just point you in the right direction? Because we do point people a lot in, provide the education, get them in the right direction. And then when they're ready, they'll come back to us. So that's the first step. And then if they determine that, yeah, you're at the point where we can really help you, we can save you a lot of money, then you'll hop on a free 30-minute consultation after that. And that's where I will talk to you, or one of the other tax advisors will talk to you. We'll review what you've got going on, and we'll talk about, here's approximately what we think we can save you and all of the things we'll do for you. So we do full service bookkeeping, payroll, tax reporting. We help you if you need health insurance. Like all of these things, set up solo 401ks, all the things that fall on your shoulder as a self-employed individual. That's really our bread and butter. That's what we help you with. So the first step is, can we help you? Can we save you? The next step is, let's review your stuff, see how much we can save you. And then we do a membership. So we don't charge hourly. We don't bill by the project or anything. You become a member. And that's where I'm working with Mike. We're going to offer a special deal just for Keller Williams agents, where you can get our services at an even cheaper price.
Yeah. So one thing that you guys are going to, the whole company will learn more about as we get towards the end of the month, is we have sought out several professionals as it relates to tax, accounting, finance, investment, health benefits, legal, and are engaging them as business resource partners to provide services exclusive to services to our agents at exclusive prices or offerings, so that we can, for the folks that don't know about what their health insurance elections are, I don't know how to set up a company, or I don't know, you didn't know about any of this today, or you don't know anything about investing in an IRA, like we will bring those resources to bear for everybody in our organization. And we'll have some announcements going out about that towards the end of the month.
Very good. Thank you for your time, Bobby. I appreciate it.
Yeah, this was great, Bobby. Very, very solid. I mean, I learned a lot, and I'm sure that I hope that everyone else did.
I whenever I'm talking about this stuff, I never know if people are listening to me or not. That's why I like the interaction, because you could careen off the side of the road if you're sitting here talking about tax code all day. It's like, all right, super boring. But I love talking about it, and I really like helping people like you just save as much money on taxes as possible. That's ultimately what I try to do here. Let you be the captain of your own ship, so that you can go talk to your current tax professional or however you're currently doing and see, do our risk rewards align? Do we have the same risk tolerance? Are you like, if your tax advisor never even brought up the S Corp to you, like that should be flag number one. I mean, that the S Corp, if you're making ordinary income netting over 40K, that should be number one on the list of strategies for you guys to take advantage of. So if there's no other questions, what I'll do is I'll give the PDF version of this, and I'll send it over to you, Michael, and also send over some resources, and we'll post them in your chat. And feel free, if anyone wants to learn more, reach out to the team, and we'd be happy to talk to you.
I love it, man. Yeah, we will send this out as follow up to the whole company. Great to be with you today, Bobby. Really appreciate you being here, and looking forward to connecting again next week.
Yeah, absolutely.
All right, man. We'll see you soon.
All right. Have a good one.
Later.